Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to today's Top Stock Pick segment with Shiraz Mian and myself, Jeremy Mullen. Shiraz will be going after me, but first I will be doing MGM Resorts, ticker symbol MGM. The stock is the Zacks ranked #1 strong buy, which operates casinos in Las Vegas, Macau, and various locations around the U.S. Its casino resorts offer gaming, hotel, convention, dining, entertainment, retail, and other resort amenities. The company's casino operations include slots, table games, as well as online sports betting and iGaming through BetMGM. I think the stock is shaping up to be a buy at current levels as the company reported a great quarter and prices coming into technical buy levels. So let's dig into this idea and learn more about the company. Okay, here is the profile page for MGM. As I can see, there is a Zacks #1 rank buy. A little more about the company. It was incorporated in 1986 and headquartered in Las Vegas, Nevada, of course. It employs 57,000 and has a market cap of 15 billion, a little over 15 billion there. The stock has a Zacks style score of A in value. That's because there's a P around 9. And then it has B in momentum, but C in growth. So we'd like to see that improve a bit. Some popular hotel casinos in Vegas that you might have been to include Bellagio, Cosmo, MGM Grand, Mandalay Bay, Luxor, and Excalibur. They also have operations in Michigan, Massachusetts, Maryland, Mississippi, New Jersey, Ohio, and New York. The company also operates in China with resorts in Macau. Now, this city is now the gambling center of Asia and the world in a sense. It actually takes in 3 times more gaming revenue than Las Vegas. So Macau, not Vegas, is generally it moves the needle for the casinos involved in Asia. If you remember this past quarter, what happened? Well, China continued to open up, and they had that momentum of opening up. And what did people do? They went to Macau and spent and lost their money. So, and as a result, we saw MGM revenues in China, they went up to 618 million for MGM. That's up from 268 last year. This really helped earnings. So let's take a look at those numbers. We're going to come down to the price and EPS surprise chart here. And if we scroll down here, we can see the last few quarters. We have this big beat in the recent quarter. This is on May 1st. Okay, but you can see they've beaten 10 on the last 12 quarters. You can see as soon as China reopened, we started to see some momentum with earnings there. Digging in those earnings, they guided Q2 209 to 215 versus the 203 previously expected. So a nice raise there. They also raised fiscal year 23 to 797 to 842. That's a big range, but it's above the 776 expected. World comparable system-wide RevPAR was up 34.3% year over year, while North America was up 25.6% year over year. Both great numbers, but you can see the difference in the worldwide RevPAR, quite higher than North America. So some notable comments. They said, while the global economic picture is uncertain, demand remains strong, and we are not seeing signs of slowdown. So very positive comments there from management. The quarter's strength was fueled by strong trends in Las Vegas and continued recovery in Macau. So let's take a look what the analysts are saying. I like to go to the detailed earnings estimates here. So let's take a look at those. And if we scroll down to the agreement, we can see that analysts are really hiking estimates. They're all hiking up over the last 30 days since earnings, and it's for every time frame into next year. Look at the numbers, big jumps, right? From 4 cents to 49, 14 to 54 for next quarter. And look at next year, we have a 100% hike here in earnings estimates. So very, very positive there. And with that, we're seeing price targets being lifted. So we have Susquehanna going from 38 to 51, a big jump there. JP Morgan went from 55 to 60, and Credit Suisse has MGM outperform, and they have a $75 price target on that. That's up from 68. Some reasons for these outperform ratings, they see strong trends in Las Vegas and that continued recovery in Macau. The Las Vegas market recovery is also recovering in the areas of groups and events, and they're saying that that's under noticed. MGM has a strong capital position, and they believe it will be thoughtfully executed. And BetMGM will remain among the top 5 digital wagering platforms. Also, Remember that low style score and growth. Well, some of these analysts think that long-term growth in New York and Asia remain positive and potential catalysts. They are looking to get approval in Osaka, Japan, so they can see some expansion into the Japanese market if that happens. Okay, so let's look at the charts and see how we might get to some of those price targets. So this is a chart going way back to 2007 and 8. The casino names, because of Macau getting its permits, really took off into the financial crisis. And these casinos really over leveraged themselves, building up there and building in Vegas. And of course, the financial crisis hit, and we just completely fell apart. They had an extremely difficult time getting out of debt because of over leveraging, and basically almost went bankrupt. So anyway, long grind back here, you can see the 5 years just kind of based at this price level. All right, this is about $10. And then at 20, same thing, just kind of based here for a full year, had some chop, grinded higher. The whole China trade war thing, the stock came back down, but was making a recovery into COVID. And of course, COVID, what's that going to do to these stocks? They're just absolutely crashed them. Came back and was doing all right, right? We were still trading in 2021 at basically all-time highs if you take away the 2008 up and down. And recently in the sell-off, came back down and kind of formed this trend line here, okay? But if you just kind of look, we're doing one of these price levels again. What I think can happen is we trade around the 40 and eventually we do move higher, and hopefully for the bulls sooner than later. Let's zoom in and see how we can get up there. So here was the recent earnings. The stock really took off nicely and made new 52-week highs, but then we sold off. The market had some weakness in here, and we sold off again, went sideways, broke this 50-day moving average, which is the blue line, and we're coming down in the area where it kind of consolidated in March. So perhaps we were trading sideways, but I wanted to give some viable levels for people. Drawing from the lows of the year basically to the highs, we do have a halfway back around 40, and perhaps we do come into this level. And I would definitely be a buyer here. We are actually long in counterstrike because I think we can pop back over this 44 and get going. However, we're going to come back into this area. This is the big buy zone. 38 to 40, 61.8% retrace, and the 200-day moving average. Really big buy area for long-term guys. Shorter term, I think we can get back over this 44. We can test these highs, perhaps push higher. And though people who are waiting for the pullback never get the chance to get in. Either way, keep your eyes on this stock. It looks pretty good. MGM is posting big numbers. The company is one of the biggest casino names, and investors should expect MGM to lead the sector in 2023. I like the earnings and the recent drop, so keep an eye on those areas of support I talked about. Okay, that's it for me and my pick. Here is Shiraz with his.
Thanks, Jeremy. My pick is a long-term one, and it's a play on my favorable outlook for the energy sector. The favorable view that I have of energy, conventional energy, oil-centric energy to be precise, looks past the ongoing macro worries about the U.S. economy, about the global economy. My sense is that long term, on the other side of this macro hiccup, we as a society, as a world, particularly on the non-OPEC side, the US and Europe to be precise, aren't investing enough in oil, in exploration and production. CapEx is essentially stagnant. And I'm aware of the dynamic, the debates about alternative energy and all of that, and I think that's good. But I've long been of the opinion that a successful strategy to move us past fossil fuels long term requires essentially that societies invest in parallel on both sides. So there's a period of 10, 20 years where we need to be mindful that we don't have shortfalls on the fossil fuel side while we are going full bore on the alternative side. Since that's not happening, I'm convinced that once past the macro clouds on the horizon, that the world will be in a very tight fossil fuel macro environment, and that's the primary catalyst for my favorable view of energy. Each one of you needs to have in your portfolio energy sector exposure. You could balance that with some alternative energy exposure as well. We have a newsletter dedicated to that. Ben Rains has some amazing picks on the alternative side. Here, my focus is on conventional energy. My pick is Chevron, but that's not the only way you could play this favorable outlook, this long-term favorable outlook for conventional energy. But I strongly feel that Chevron today offers a very good risk-reward balance in terms of exposure to the sector, in terms of financial strength, in terms of cash returns, and also commodity leverage. If you do have a higher tolerance for volatility and risk, it's perfectly okay to go with one of the broad-based oil field service players, Schlumberger, for example, SLB, Halliburton, HAL, or even a pure play E&P player. My pick there would be Pioneer Natural Resources. But Chevron, I think, has one of the best long-term production growth profiles amongst the super majors. The stock hasn't really done much lately. In fact, it's down about 10% this year, at a time when Exxon is up 12-15%. Part of the reason for that is the oil overhang. Chevron is more oily than Exxon. And Chevron has had some operational challenges as well. This quarter wasn't too bad. The earnings release I'm referring to, the Q4 release in January, the market was totally disappointed with it. But I believe beyond this near-term challenges, operational challenges, which is, by the way, giving us a very attractive entry point in a truly blue chip oil play, the production profile changes materially in the second half of the year, and then in 2024, dividend has been as safe as any equity can have. Currently yields about 4%, and as I mentioned, it's down about 10%. So fortress balance sheet, strong leverage, impressive long-term growth profile, both domestic and Permian, as well as international in Kazakhstan. It has LNG in Australia, has offshore Gulf of Mexico, has offshore Brazil. So a very strong asset base, strong oil price leverage. And I believe if you hang on to it, even from a tactical standpoint, this is a $200 stock. Once the near-term production issues that has held the stock down becomes clear after the Q3 release or the Q4 release, that it's behind the company. So that's my pitch for the space as a whole, and my preferred pick of Chevron.